Welcome back to our podcast, where today we're diving into the core of corporate finance. From valuation models to capital structure, we'll break it all down. Let's start with the basics. What exactly does corporate finance cover?
That's a great place to start. Corporate finance primarily revolves around how businesses fund their operations and growth. It involves key decisions on capital structure, funding sources, and maximizing shareholder value. It's not just theoretical, there are practical applications too. For example, understanding investment analysis and determining how much return is necessary on investments.
So, corporate finance isn't just about raising money, but about making decisions to increase enterprise value, right?
Exactly. It's about making informed decisions, whether it's through debt, equity, or other instruments. And those decisions must align with the company's long-term strategy. A company could choose to invest in new projects, expand its operations, or even pay dividends to shareholders. Each of these choices has a financial impact.
And there are tools and models to help make these decisions, like valuation principles.
Yes, valuation models are central. For instance, the time value of money is crucial. It helps businesses figure out how much future cash flows are worth today. We're talking about discounting future cash flows to determine present value and vice versa.
That makes sense. But I guess these models only work if we understand the risk involved, right?
Absolutely. Risk is a huge factor in finance. The required rate of return is linked to the risk of the investment. Higher risk generally demands a higher return. It's not just about how much money you can make, but how risky the investment is. That's where concepts like standard deviation and beta come into play, measuring the variability and the relationship of an asset's returns with the overall market.
So when we talk about beta, we're essentially discussing the volatility of an investment relative to the market?
Yes, exactly. A beta greater than 1 means the asset is more volatile than the market. Less than 1, and it's less volatile. This measure helps investors understand how much risk they're taking on compared to the overall market.
Got it. Let's talk about the capital structure now. I know it's important in corporate finance, but why exactly does it matter?
The capital structure, whether a company is financed through debt or equity, affects its overall cost of capital. According to Modigliani and Miller, in a perfect market, the structure doesn't matter. But in reality, taxes, bankruptcy costs, and other factors influence how much debt a company should take on.
And that's where the concept of the weighted average cost of capital, WACC, comes in?
Exactly. WACC is the average rate of return a company is expected to pay to all its stakeholders, debt holders, equity investors, and others. It's a key metric to determine if an investment will provide a return that justifies its cost.
It sounds like understanding a company's cost of capital is essential for making decisions about financing new projects.
Yes, it's critical. If a project's return is higher than the WACC, it's a good sign. If it's lower, the company may want to reconsider or find a different financing option.
And then there's the dividend policy, which has its own challenges, right?
Yes, dividend policy can be tricky. In perfect markets, dividend policy is irrelevant. It doesn't impact the company's value. But in real markets, taxes, investor preferences, and even company-specific factors make dividend decisions important.
So, it's not just about deciding whether to pay dividends, but how it aligns with the company's broader financial strategy?
Exactly. Some companies may prefer to reinvest their profits for growth, while others may distribute them to shareholders. It all depends on the company's goals, tax considerations, and market conditions.
So, it's all interconnected. Valuation, capital structure, investment decisions, and dividend policy?
Yes, it's a balancing act. Every financial decision impacts the other. A company must be strategic about its choices to ensure long-term growth and stability.
And all of these concepts tie back to maximizing shareholder value, right?
Right. Ultimately, that's the goal. Every decision in corporate finance should aim at increasing the value of the company, which in turn benefits the shareholders.
This was a lot of ground to cover, but we've barely scratched the surface. I'm sure we could dive deeper into each of these areas.
Absolutely. There's so much to explore. We've touched on key areas like valuation models and risk, but each concept has layers of complexity.
We'll save that for another episode. Thanks for breaking all of this down for us today.
My pleasure. Corporate finance may seem complex, but understanding the fundamentals really helps make sense of the decisions businesses face.
Well, that wraps up today's episode. If you found this helpful, be sure to join us next time for more discussions on corporate finance. Take care.
See you next time.